3 companies at 52-week lows. A great place to start to look for value is when companies are hitting these 52-week lows. Company number 1, Warner Brothers Discovery. Guys, if you look last 10 years, this company is down 81%. 81%. That's a big, big drop. Now, this is a company. Here's my first sound of alarm. Market cap, $19.7 billion. Market cap, buying the number of shares outstanding multiplied by the price per share. If you want to buy all the shares out there, it costs you $19.7 billion. Enterprise value adds in the debt, nets out the cash. So you want to buy the whole company in full, use all the cash to pay down debt, and then also write a check for all the debt. That's enterprise value, $92 billion. This difference is essentially the net debt. That's a lot of debt, guys, especially when you compare it to the 5-year average free cash flow of $3.5 billion. That leads to a number that I don't feel very comfortable with. I'm in the 8 pillars, and the 1 pillar right here, 5-year free cash flow into the amount of long-term debt, 17.5 times. Now, could that be okay for a company like them? Sure. But when you have this much debt, when you have this much of astronomical debt, and then $45-50 billion of long-term liabilities, if the rate goes up just 2 or 3%, how much are you eating up your free cash flow? It's a big number. In addition to that, we do see a big jump in free cash flow. In the last year, it was $6.2 billion versus the 5-year average of 3.5. And if this continues, this number is going to drop precipitously. But in the meantime, you need to understand, what is this free cash flow? Why was it so high compared to the previous years? That's the big check. So let's go see what it shows. This is the cash flow. I'm going to go annual, our cash flow statement. And we put in, actually the cash flow has been pretty strong. 1.2, 1.2, 1.3, 1.5, 2.4, 3, 2.3, 2.4, 3.3, and that big jump to 6.2. So there is a big jump here, which could be a new stabilization for them. It could be great for them. Feels a little scary though. Let's go check out their net income. Oh, this is interesting. So their free cash flow is positive in the last year and last 5 years, but their net income is negative. Understand that. You got to understand that. For me, guys, too much debt in the company. I'm just a little apprehensive about it. So for me, I'm just going to go ahead and wait until they make their balance sheet better. Company number 2, Pfizer. Now, I love talking about Pfizer because Pfizer was a company that when we first started this channel, Pfizer was growing big. Why? COVID. Their COVID revenue and profit. And we kept saying, guys, this is probably temporary. Just yesterday, I think the CDC came out and said, treat COVID like the common flu. That's how you have to treat it now. So the question you have to ask yourself is, will Pfizer continue to make a lot of money from that? Let's go check out their income statements over the last few years so you can compare. Before COVID, 40.8, 40.9, 41.6, 81.3, 100 billion. Now it's declined to 58.5 last year. It's a big drop. Why? The COVID vaccine stuff. Now, Travis Kelce is a great endorser for Pfizer, and he's got there telling you get your shots. And I'm sure there'll still be a trickle of revenue, but it's not going to be what was here. That's what we warned about. Guys, be careful when buying this. Look at their profit in those 2 years as well. They went from $9 billion to $22 to $31 billion in profit. Those are big jumps in profit. And last year, $2 billion in profit. Now, they did have some big other income and expenses in those years with big declines, but it's still a lot pushing onto one product. And if you look at the stock price, this is the interesting part, guys. The stock price is at $25 per share. It hit an all-time high of $56.33 back on December 20th, 2021. We sat there and warned, like, listen, be careful whenever a company has a massive increase in revenue for random reasons, for one-off reasons. But also look for opportunity when companies have massive drops for one-off reasons, like Southwest Airlines during COVID, like the vacations, like hotel groups during COVID. Those are ones that are going to stay low for a long time, just like these ones won't stay high for a long time. But the big key for Pfizer is, what does their pipeline look like? So this here, guys, is their pipeline. As of January 30th, 2024, there's phase 1, phase 2, phase 3 registration. The earlier it is, the less likely it's to happen. As you go along the path, it's more and more likely to get into approval and get out to the market. So this pipeline's good. Now you might look at this and say, hey, there's a good pipeline here. But remember, you got to make sure the pipeline isn't just plentiful, but they're marketable products that can make a lot of money. Now, my guess is Pfizer isn't going to waste much of their time getting things into registration mode in phase 3 without having some sort of reliance that's going to move the needle. But if you want to understand, this is why I tell people, in order to understand biopharmaceutical, you need to understand that pipeline. Make sure they're bringing more and more drugs to market. Because remember, you only have 17 or 20 years on these drugs. The second the patent runs out, revenue falls 80-90% because the generics come out. 13 years ago, I started taking Propecia. A few years later, the generic came out. And guess what? I went from spending like $200 per prescription to like $9 per prescription. Of course, I'm going to switch it off to the Propecia generic, which was finasteride. So a lot of guys watching, I'm sure somebody out there is on Propecia, and if you aren't on finasteride, go on finasteride because it'll save you a ton of money. Stock number 3, Starbucks. Now this is an interesting one, guys. Starbucks is a great company selling for $91 a share, all-time high. July 31st, 2021 of $126, 52-week low, $89.21. So it's off the low, but it's still pretty low, which I like seeing. Gives me opportunity to sit there and look at a company. This is what I like about Starbucks. $104 billion market cap, and even though it's retail, I'm actually surprised that the enterprise value is only $34 billion more, because those leases count as liabilities. They pay a dividend, for those of you who love dividends, 2.4%. It eats up a big chunk of their free cash flow, though. Last year, they did $4.4 billion in free cash flow. The last 5-year average, $2.8 billion. And look at their dividends paid, $2.5 billion. And with such a high return on invested capital, this is obviously skewed by the fact that they've decreased, obviously, their capital base. But for me, I look at Starbucks saying, okay, where are they going to grow? How are they going to get out there and grow more? And that's the question you have to ask yourself. Because paying out this dividend, I look at it going, guys, if you have a lot of growth potential, why do you have so much out in dividends? Go open more stores and expand in growing markets, China, things like that. Go find those places where you can go sit there and put a presence in there and generate more and more money. So gross profit margin of 28%, 5-year profit margin, 10.9%, 1 year, 11.7%. So pretty consistent. Now, there are going to be higher prices coming for Starbucks. Why? The unions are getting in. People are starting to unionize in these stores. It's probably going to be inevitable that this happens. I'm not going to speak to that as a fact. I just wonder if that's going to happen. So what's going to happen to Starbucks pricing? Probably going to go up. But it doesn't mean that if I polled 100 people and said, name me a coffee company, how many of them are going to say Starbucks? Talk about brand awareness. Talk about moat. There are literally areas in which there are Starbucks across the street from each other. Talk about a moat. I don't drink coffee, but I love their peppermint hot chocolate. And there's another double chocolatey, like low-calorie drink they have that my fiance put together for me. She found it on some Instagram account. And it's like 100 calories for this delicious double chocolatey, like Frappuccino thing. I love that. I don't green drink coffee itself, but I love the peppermint hot chocolate when it comes out in the wintertime. All right, so let's go check out this company a little bit further. Let's look at the 8 pillars. All right, actually not as bad as I thought it would be. The biggest numbers here are the 5-year PE of 31.8 and the 5-year price free cash flow of 37. So that's obviously driven by the fact that their net income in the last 5 years is higher than their free cash flow. So what's the other X? The debt. I'm not worried about this. This doesn't bother me. They got prime locations in a lot of great cities. I'm not worried about that. That's a big chunk of their debt here. So to me, this doesn't even bother me. Like I said, guys, 8 pillars tell a story. Let's see what analysts are saying about Starbucks in terms of their earnings per share. Expected to make $4.20, growing to $8 a share in the next 4 years. That's some big growth right there, guys. Big growth. That's why they can afford that dividend. Big growth in earnings per share. What about revenue growth? Oh, wow, I'm surprised by this. Pretty much double-digit revenue growth, too. $40 billion this year to $59 billion in 2028. Kind of surprised by that. That's incredible. Big-time money here. So, guys, the question we have to ask ourselves is, what's the right price to pay for Starbucks? Remember, the company and the stock price are different things. You have to merge the story with the numbers. So we have a great story with Starbucks, a great brand, great everything, brand awareness, brand love, loyalty. You cannot name, Coca-Cola is the only other drink company I could think of where the brand loyalty is that high. Starbucks has that. So the question becomes, what's a reasonable price to pay for Starbucks? Now, before I get into this, guys, I want to explain to you that this software and this community up here wasn't just created by me. It was actually created because viewers of our channel kept asking me, how do I get the software that's behind you? Good news is we have a great promotion running right now, $7 for 7 days. Let me show you what it gets you. Guys, in our software here, you get the mobile app, you get the 8 pillars, over 30 years of financial data, the stock analyzer tool, which we're about to do for Starbucks, exclusive content, access to Mo and I, 8-pillar portfolio, retirement calculator, but most importantly, guys, the Everything Money chat with like-minded investors. Over 16,000 people have signed up, thousands of active users in there because investing can be a lonely road. So why sit there and just internalize everything? Get out there, talk to like-minded people who will challenge you with your ideas. And like I said, guys, our usual rate is $49 a month. It's $7 for 7 days right now at everythingmoney.com. You compare it to our competitors. We are obviously a better value for a value channel, and we provide way more. So guys, go check it out. I'm not asking you to make a huge long-term commitment. I'm asking you to make a 7-day commitment, and it's only gonna cost you $7, everythingmoney.com. Let's go check out Starbucks in the stock analyzer tool right now. I'm gonna pull up where I did it in the past. S-Bucks. I only did it about a month ago. All right, so I went a little more conservative on the revenue growth level. I did 6, 8, and 10% over the next 10 years. If you remember, analysts were expecting about 10% revenue growth for the next 5. So I went a little bit lower because further out, less. Plus, analysts tend to be a little more aggressive. Profit margin, I did 10, 11.5, and 13. They did 11.5 recently. In the last 10 years, they've done 12.3%. So I feel comfortable with 11.5%. Free cash flow, I just kept the exact same thing. Their free cash flow tended to be a little bit higher in the last 10 years, but significantly, by the way, about 10% higher. But that's okay. I'm going to keep it at the same level. PE. Guys, what PE would you assign for Starbucks? Remember, Warren Buffett bought Coca-Cola in 1987 at 30 times earnings. What's a reasonable price for Starbucks? I'm putting in 17, 20, and 22.5 for PE and price of free cash flow. Guys, I'm not going to lie, that could be really low. This is the art of investing. This is why you need the community to sit there and talk to people and say, what PE would you assign? Clearly, a 15 PE is not reasonable for this company. This is a market leader. This is a moat. This is a luxury that everybody loves. They don't give up. You got to pay more for it. They have a high return on capital. You got to pay more for it. If you try to buy a Starbucks for 15 PE, then I think you're going to miss out on that opportunity. You might get it every so often, but you need to pay up for Starbucks. And now, doing what's the desired return? I'm doing 9%, guys. This 9% is basically the market return. I'm putting no margin of safety in right now. I just want to sit there and say, hey, based on my assumptions, what's the company's value at each level of assumptions, low, middle, and high, based on a market return of 9%? So I hit the analyze button. I got a low price of 67, high price of 140, middle price of 110. Of 100. It's on my watch list at 80. It's getting pretty close. Maybe I go a little bit higher. Guys, everythingmoney.com, $7 for 7 days. And guys, if you like this video, go check out the 30 stocks that I want to own forever in our next video. Thank you for your time.